Welcome to today's Explainer. We're breaking down a pretty monumental Tuesday in the financial world. It's like Wall Street, Washington, and Web3 all showed up to the exact same party, but wearing completely different outfits. We're looking at massive fintech flexes that literally all happened in a single 24-hour window. It just proves that the financial landscape is shifting faster than ever right now.
Seriously, we saw a total everything, everywhere, all at once scenario yesterday. The sheer volume of major earnings and massive product drops hitting the ecosystem simultaneously was just staggering. It was the kind of day where the old guard and the bleeding edge totally collided. I mean, we had 5 of the biggest banks in America drop earnings before the opening bell, a massive card network launch a brand new AI tool, and a blockchain that's barely 2 weeks old muscle its way right into the big leagues.
So to make sense of all this chaos, we've got 4 key items on the agenda today. 1. Big banks are back. 2. Visa's new AI therapist. 3. Robinhood builds the highway. And 4. The fintech regime change.
All right, let's jump right into section 1. Big banks are back.
JPMorgan Chase set the tone immediately. They posted a staggering 41% year-over-year jump in profit. Think about that for a second. To see a legacy financial institution of that unbelievable, massive size achieve hyper-growth numbers, the kind usually reserved for scrappy tech startups, well, that's a massive signal to the rest of the market. And the craziest fund? They absolutely weren't alone in this surge.
Goldman Sachs actually posted the best quarter in its entire 157-year history, pulling in nearly $21 in diluted earnings per share on over $20 billion in net revenue. That was padded beautifully by SpaceX's record-setting $86 billion IPO, which totally signals that deal-making is back from its 2-year hibernation. Meanwhile, Citigroup kept its turnaround story completely alive, and Wells Fargo beat estimates right alongside them.
Now pay close attention to exactly who CEO Jamie Dimon name-checked on their earnings call: Stripe, PayPal, Block, Chime, SoFi, and Revolut. He knows the landscape is shifting. This proves JPMorgan knows they have to keep investing heavily in their own tech rather than just coasting on their massive size. They're looking directly at the disruptors and recognizing the very real threat they pose.
The big takeaway here is that consumer spending remains remarkably robust despite elevated interest rates, which is a massive win for traditional institutions. JPMorgan CFO even pointed out that spending is strong across all income segments and delinquencies are actually coming in lower than expected. Keep in mind, these earnings dropped on the exact same morning as the June CPI report. Together, they basically turned the day into a single, undeniable referendum on the absolute strength of the American consumer.
But, as traditional banks sit there counting their massive profits, it really begs the question, who is protecting your actual spending data? Because while the banks hold the money, the networks that process those millions of robust daily transactions are making an incredibly aggressive move of their own. Which brings us to Section 2, Visa's new AI therapist.
So Visa just debuted an AI financial assistant. It's essentially a conversational tool built for banks to embed directly into their apps to offer financial advice. This is a brilliant defensive play to keep card issuers and customers from wandering off to third-party budgeting apps. By offering a tool that banks can just plug right into their existing platforms, Visa's making sure consumers don't need to look outside the traditional banking ecosystem for financial guidance.
This is what the industry calls Agent AI. That means it doesn't just answer your questions, it actively works on your behalf to achieve your goals. And it's incredibly powerful because it's trained on 257 billion yearly transactions of Visa's very own data. Just think about the sheer magnitude of that data set. They're utilizing global consumer purchasing behaviors at an unimaginable scale to train an AI that understands how people spend money better than almost anyone else on the planet.
The card networks are aggressively evolving their whole model. They want to move away from just being simple processors and become your personal financial hype man. Analysts are flagging this as a massive shift. They don't want to just be the invisible rails that process your card's swipe anymore. They want to be the active voice in your ear, whispering budgeting advice and securely authenticating your identity through advanced AI fraud tooling. And of course, taking a cut along the way. The key takeaway from Morgan Stanley and William Blair analysts is that Visa is building a digital moat out of your own spending data before someone else gets the chance. They're using interconnected consumer commerce as a massive hedge against competitors, leveraging the sheer scale of their transaction data so neither traditional banks nor emerging tech startups can easily bypass them.
But here's the catch. Visa is aggressively protecting its centralized network, right? But what happens when the very infrastructure of finance itself becomes completely decentralized?
Because while Visa's busy building its walled garden, a whole other segment of the fintech world is trying to tear those walls down entirely.
Let's get into Section 3. Robinhood builds the highway.
Robinhood recently launched its new Arbitrum-based Layer 2 network. If you're not familiar, that's essentially a faster, cheaper blockchain built on top of Ethereum. Well, it immediately muscled its way into the top 3 decentralized exchange blockchains by daily volume, generating $3.1 billion in volume in its very first week. That is an absolutely staggering debut, placing them directly behind established industry giants like Solana and BNB Chain.
The sheer speed of adoption here is just mind-blowing. Going from 0 to top 5 in the time it takes most apps to fix a minor bug, that's insane. We're talking about 65,000 users locking up over $100 million in total value almost overnight. That includes $300 million in deposited stablecoins and $13 million in tokenized stocks, right out of the gate. Now, analysts did note that meme coins drove a lot of that early volume because, well, in crypto, some things never change, right? But their partnerships with Uniswap, Chainlink, and BitGo show some seriously huge infrastructure ambitions. They're setting the stage for running real-world assets on Robinhood's own rails. We're talking tokenized stocks, decentralized lending, and perpetual futures, all on a massive scale. The big takeaway? Robinhood didn't just build a trading app anymore. It built the highway. This marks a massive shift from being just a slick interface for you to buy stocks to actually paving the decentralized roads that future financial transactions are going to drive on.
And that perfectly sets up Section 4, the Fintech regime change.
When you look at this trifecta altogether, it's wild. From 157-year-old traditional Wall Street banks posting record profits, to payment networks launching agentic AI, to 2-week-old Web3 platforms decentralizing the infrastructure. We are witnessing a massive regime change where literally every sector is aggressively competing for consumer dollars. Legacy banks are flexing their massive capital, payment networks are making themselves indispensable financial assistants, and Web3 is successfully rewriting the infrastructure of trading.
So, with Wall Street, AI, and crypto all moving at lightning speed, I'm going to leave you with this final thought. In this new everything, everywhere financial regime, who will ultimately control your wallet? As the lines continue to blur between legacy banks, intelligent payment networks, and decentralized blockchains, which of these infrastructures will actually win your trust? Thanks so much for joining me for this explainer, and definitely stay curious as we watch this fascinating financial future unfold.